The secret life of Dennis Levine is about to become an open secret. No, not what he did that sent him to Lewisburg Penitentiary for insider trading on Wall Street. Everybody knows about that. He's even written a book about it. But what he's been up to since he got out of Lewisburg. This man who told us he'd never do anything illegal or unethical again. First, let's go back to Levine's high-living days when he was making millions illegally sharing inside information and trading on it, sometimes using a private phone line in his office at Drexel Burnham Lambert.
What was it like when that phone rang?
It was like a cash register going off.
Like the day in 1985, Levine traded on inside information in Nabisco stock.
No sooner did the stock open that my phone lit up like a Christmas tree. And each of the people involved called to say, how did we do? It was this incredible feeling of invulnerability, of a rush that in pushing a button, in making 2 phone calls, I made close to $3 million. And that's what drove it. That was the insanity of it all. It wasn't that hard.
It was so easy that in just 5 years, Levine stashed away $12.6 million in a secret Bahamian bank account. But that wasn't enough.
You get bolder and bolder and bolder, and it gets easier, and you make more money, and it feeds upon itself. And looking back, I realized that I was sick, that it became an addiction, that I lived for the high of making those trades, of doing the next deal, making the bigger deal.
Sometimes when you would come home, did you ever look at your wife and say, I'm risking all of this?
I didn't think I was, Ed. Foolishly, I thought I could outsmart the system. But I was wrong. I never thought I'd get caught. I never thought I'd get caught.
You're pushing, please. Mr. Levine, any comment?
But on May 12, 1986, he did get caught.
Mr. Levine, are you sorry for what you did?
Levine pleaded guilty to securities fraud, tax evasion, and perjury, and he cooperated with the government. He turned in the members of his ring and arbitrageur Ivan Boesky. Levine served 15 months at the federal penitentiary in Lewisburg, Pennsylvania, and was released in 1988. He says he's turned his life around. Levine now runs his own financial consulting firm
Look forward to seeing you too.
and lectures students around the country on the lessons he's learned from his mistakes.
I think I have a higher standard. I think one of the standards that we should all have is whenever we're about to do something, step back and ask yourself, is this something I'd like to read about on the cover of the Wall Street Journal tomorrow? If the answer is yes, then you're probably doing something right. If the answer is no, then don't do it.
Do you think that you would ever do anything clearly illegal again?
Not only wouldn't I do something clearly illegal, I wouldn't even get close. Once burned, Ed, you don't go near the fire. I've learned a lesson.
What about something that's unethical? Would you draw the line there?
Yes.
Don't tell Randy Yoakum and Tom Brechtel, 2 small businessmen, that Levine hasn't done anything unethical. They hired him as their financial advisor about 1.5 years after Levine got out of prison. They wanted to develop this oceanfront property at Laguna Niguel in California. They paid Levine $10,000 in upfront fees. In return, he was to help them find financing to build luxury homes, from which they all expected to share in a profit of $14 million. Part of Levine's job was to check out the legitimacy of the people and companies he recommended. That's called due diligence, and make sure they could do the deal. So Levine took Yoakum and Brechtel to Panama, where he introduced them to 2 companies, Morgan Gundy and Pan Global. Pan Global agreed to lend them $32 million, as long as Yoakum and Brechtel paid upfront fees of about $150,000. Yoakum and Brechtel paid the money after Levine told them he'd pulled off a great deal.
He worked miracles out there. He danced.
He was a miracle worker.
He danced?
Yeah, and he jumps up and down and says, "This is great, guys. You don't know how your lives have changed."
Dennis says this.
Dennis says it. And I mean, you know, it sent, you know, goosebumps up and down my spine, you know, and it felt good. You know, I felt great.
What made you think that these were substantial companies, that these were companies that would do funding?
I had a client that verified unequivocally that somebody else received funding as a result of that operation.
And you did no investigation beyond that?
No, I didn't.
Are you aware that Pan Global and Morgan Gundy, the two companies that you recommended, have never sold any stock in Panama to anybody?
Based on the information I had, they had done deals in the past.
Do you know that they're both under investigation by the FBI?
I have no specific knowledge of an investigation.
Our investigation showed many companies paid upfront fees to Pan Global. We found none that got any money in return. We also found that the U.S. Embassy in Panama and the Commerce Department warned businesses to stay away from Pan Global. Not surprisingly, the Pan Global deal fell through on a technicality, but Levine came up with another lender, this time out of Florida, and this time it would be costly. $25,000 to Levine for the introduction, and another $300,000 up front to the lender to do the $23 million deal. After losing about $150,000 in Panama, Yoakum and Brechtel didn't have the money. So Levine introduced them to Bob Amira, a Las Vegas businessman who Levine said could find a venture partner, someone who could come up with the upfront fees in exchange for a piece of the deal. How does Dennis Levine characterize Amira?
Just an associate, somebody that he knew during his days at Drexel.
Did you check him out before recommending him?
No, no.
But isn't that part of what you do? Check out companies, check out individuals?
All I did was make an introduction.
Were you aware that he's a convicted thief?
No,
That he has ties to the New York Mafia?
I had no idea.
No idea? We checked him out and found that Amira had been convicted of theft for his part in a credit scheme that netted over $700,000 from 2 Atlantic City casinos. State investigators said the scheme was engineered by New York mobsters. So you didn't check him out? You didn't do due diligence as far as he was concerned?
He contacted me, indicated that he has capabilities in getting loans. He can do real estate transactions. That's what his expertise is. And I thought perhaps because he had contacts I don't have or capabilities I don't have, he could help Tom and Randy.
But he couldn't. And eventually, Levine came up with yet another possibility. Jim Massaro, Levine said, could help them with the Florida lender.
Characterized him as a friend that he's done business with before from his days at Drexel.
How did you know Jim Massaro?
I knew Jim from the time I was at Lewisburg.
Lewisburg Penitentiary, where Massaro and Levine spent almost 9 months together. Did you tell them that?
I'm not sure. I'm not sure they knew that.
Did you tell them that he had been convicted of business fraud?
I don't recall telling them that now.
Should you have told them that?
Why?
You're their financial advisor. I mean, if somebody's going to do business with somebody who's been convicted, I think they have the right to know. Then they can make their own decision. I'm not saying that
Well,
what he did.
I would be a hypocrite. They clearly knew what my background was. I don't hide it. I'm very upfront about it, Ed.
Right. But did they have the right to know about Jim Massaro's background, that he had been convicted of business fraud, and that the two of you met in the Lewisburg Penitentiary?
Perhaps.
Why didn't you?
I wanted to help Tom and Randy. That's what this is all about.
Eventually, Randy and Tom met the second lender, who Levine said could fund the deal. It was a Florida company, Earnscliffe Trust, headed by Robert Wilson, shown here at a business function in American Samoa. How did Dennis Levine describe Robert Wilson?
Supposedly a big wheel in the lending business at the high level.
And Lee Leibarger.
He was a heavy hitter.
And you're relying on Dennis Levine's judgment here.
During this past year and a half, 2 years, we have relied totally on Dennis Levine's judgment.
If he brings you to a guy, the guy's okay.
That's right.
What specifically did you tell him about those two guys?
I said it's a new operation. They're expanding. They've developed a novel concept. They have provided very good references that have been checked out.
Checked out by?
By other clients.
Had you checked them out?
Yes.
You checked them out. So then you were aware that Leibarger is a convicted thief?
No, we didn't. I didn't do a background check on that, no.
But we did a background check on Leibarger and found not only this mugshot, but that he had defrauded at least 4 people of over $120,000 in a business scam in the early 80s. Last December, he was arrested on charges of running an upfront fee scam out of New Orleans.
You were aware that Wilson had outstanding legal judgments against him?
I had no idea of that.
You were aware that he'd made promises to other businessmen to fund deals that he'd never funded?
At the time, I was not aware of that either.
But you checked him out?
They were checked out. They had lawyers, they had people representing them, they had bank references.
Based on the information that we have, our background check, Earnscliffe has taken in at least $2.5 million in advance fees but never paid any client any money. It has no assets. Its banking and credit references are phony. It's not licensed to operate in Florida or anywhere else in the United States. It's not registered as a dealer of securities in Florida. That's what our background check shows. Your background check shows something different?
When we discussed this situation with the clients, we told them it was new. They had just opened up an office. It was we never ever told a client anything that wasn't true.
In March of 91, the Florida Comptroller's Office shut down Earnscliffe Trust, alleging the company was bilking consumers out of upfront fees for loans that were never made. Brechtel and Yoakum received no money from Robert Wilson.
What does all of this look like?
What?
You know, I hate to say it, Dennis, but it just doesn't, on the surface, look good.
Then let's look beyond the surface. Let's get right down to the specifics in the documents.
But each time I get down to the specifics of the people involved, I don't see due diligence on your part. I'm trying to give you the benefit of the doubt.
Right.
To tell me how you came up with these people who are a group of convicted con men, thieves.
The story, as you tell it, based on the documents that you've reviewed, is imbalanced. Again, I'll go back to what I said. I'd like an opportunity to provide you with my information, my background, and I think you'll see a totally different version.
Levine gave us more than 800 pages of documents, and after looking at each of them, we didn't find a different version. We found no evidence that Levine did due diligence, that he checked out the people or the companies he introduced to Brechtel and Yoakum. We also found nothing in all of this that showed Penn Global or Earnscliffe Trust had ever funded a deal. We did uncover this. On one document, Levine had whited out the name of a company he had advised. We scratched off the whiteout and called that company. Its president told us for upfront fees of $20,000 to Levine, he too had been introduced to Penn Global and Earnscliffe. But unlike Brechtel and Yoakum, who say they're out over $200,000, he pulled out of the deals because of suspicions about the companies. He's still waiting to get his money back from Levine.
What would you say to people who would accuse you of being a con man?
It's absolutely false. I've never conned anybody in my life, nor would I.
I mean, some people have described you as a consummate con man, that even to the point that sometimes you con yourself. What would you say to them?
People are entitled to their opinions, but it's not true. I have to live with myself. I don't think I've done anything wrong.
Because traders in the brokerage industry commit to multi-million-dollar deals on phones, through faxes, and over computer terminals, almost always with people they never see, one of the cardinal rules of the business is know your customer. Well, Daniel Taibo is one customer they didn't know, and yet more than a dozen of Wall Street's largest brokerage houses did deals with him. Taibo is now accused of running possibly the largest free-riding scam in the history of the Treasuries market.
85 million up, 4 plus you buy, 12 plus you sell.
Why would you do 35 million on the Augie?
The language, the phones, the chaos, the speed, the flashing computer screens, the waves of information all make the world of bond traders inaccessible. Only those who are members of the club understand the cryptic language and practices of the business.
I'm a seller right now. I'm long. Don't hit a 29 bid. I'll buy him at 29, all right? That's fine.
According to the Securities and Exchange Commission, Daniel Taibo used his understanding of bond trading to lure about 25 Wall Street firms into making multi-million-dollar deals, trading a total of $165 million with Goldman Sachs and more than $250 million with just 3 smaller brokerage houses.
I would say, conservatively speaking, he put $1 billion at risk on the street.
$1 billion?
With a B, that's correct.
Tom Pirro and McKay White of Compliance Data Center are in essence financial gumshoes. When brokerage firms call them, they track the con artists and deadbeats working Wall Street.
How much could he have made from that?
Well, the sky's the limit, I suppose, if things went his way.
Augie 17's coming into us. Covering is short.
Somehow, Taibo would get the direct number of the trading desk and just call the brokerage firms claiming to be a big player. Robert McDonough, who works in the corporate credit department of Merrill Lynch, was one of the first people to catch Taibo and report him. He said that the first time Taibo called, he wanted to buy a huge quantity of treasuries.
We're talking about $500 million.
So he wanted to do a deal involving $500 million?
Yes, $500 million.
How did Taibo get what they call on Wall Street a free ride, trading securities without paying for them?
He was hoping that the market would go in his favor for one day, and he would close out the trade by the end of the day and just have the proceeds.
So the free ride is basically you're taking a gamble that it's going to go up. You don't put any money up for these millions of dollars of securities?
If you close the transaction out by the end of the day, you do not have to put up any money.
And if it goes up by the end of the day or the next day, you can then turn around and sell it and you keep the difference?
You keep the difference, that's correct.
The government estimates that in just 17 months, Taibo made about $200,000. But when his trades went bad, a number of the brokerage houses lost hundreds of thousands of dollars.
See, that's the fly in the ointment as far as the brokerage houses are concerned, is if things didn't go his way, they were stuck with losses.
I mean, it has to be pretty embarrassing for them to have been taken by Taibo.
Sure, I'm sure they're embarrassed. But more than embarrassed, I would suspect that they might be pretty pissed off.
You're talking about a gentleman who spoke a very good Wall Street. He spoke a perfect Wall Street, okay?
Willie Daniels is the founder of United Daniels, a small brokerage house.
He was up to date on everything. He knew exactly what he wanted to do. He described the security he wanted perfectly. He described how he wanted his orders perfect, as though I was doing business with a trader from one of the major New York City banks, okay?
Daniels was one of the few traders Taibo was unable to con.
How do you figure these people at other firms did business, multi-million-dollar business, with a total stranger?
It's done every day in our business, okay? You get your respect in this industry based on your numbers, your production, okay? Here's an opportunity to do this trade, okay, and I'm going to gross X number of dollars, which X goes in my pocket, okay? The greed was there in terms of the dollar.
Until recently, Daniel Taibo had had only a brief conversation at his door with Eric Pooley of New York Magazine, and it looked like we weren't going to get much further when we stopped by his home one Sunday afternoon. But after a while, Taibo decided to change into his Wall Street garb and talk to us.
For example, I brought you a copy of my transaction with Goldman Sachs. Okay. And
Goldman Sachs said you took them for a lot of money.
No. My account statements are here. These are all the repo transactions.
9 million?
Yes.
4,950,000?
Yes, these are 4 million.
Million 9? 5 million 3?
Right.
5 million 31?
Right.
You're dealing in big bucks.
Well, it's a leverage market. I mean, the whole thing is leverage.
Taibo explained how he did his deals.
For example, this repo transaction that I bought a security. I don't have the money to pay for it. And I went to the repo market and borrowed the money to cover the security.
Is that legal that you can buy it?
Yes. That is what all of them are doing. Look at their financial statement.
The repo market allows traders to buy bonds and then get a loan to pay for them using those same bonds as collateral.
Goldman Sachs, Solomon Brothers, Paribas Bank, they all have collateral. So when you go to borrow this money, what do you use for collateral?
What do you mean by they all have collateral? I don't understand.
Well, I mean, Goldman Sachs has got capital.
Yes, they have.
What do you use for capital?
Well,
what do you use to say, okay, you're dealing with $10 million here? You have to have something to back it up. Suppose the market goes down and you lose, and you've got to pay the money. What do you use for collateral?
Okay, here you are. You can see, for example, I borrowed $9 million or whatever it is, and the cost of borrowing that $9 million is $799. You have that.
You can borrow $9 million and it only costs you $799.
Yes, on the repo market.
Tom Pirro says Taibo couldn't have done that without forging stacks of false financial statements.
He was trying to give the impression he was worth 25 mil, 30 mil, whatever the case may be. So a firm would say, well, he's got the money, this is fine, let's go ahead and do this transaction with him. If he said he had possibly a Pontiac Le Mans in his driveway and $2,000 in Rockville State Bank, they're not going to do that type of trade with him. Simple as that. Too much at risk.
Where's your office, by the way?
I work from my basement.
Taibo took us downstairs to his basement office, a dark room with unfinished walls, and showed us the equipment he used to make his multi-million-dollar deals with the biggest brokerage houses in the world.
So basically, with this setup here, with these two computers, you've got another computer back over here. This is a connection with the satellite system. Your telephone, the modem. What's this?
It's a typewriter.
So with this, you can be in touch with anyone
In the world.
in the world.
Right.
You can get any financial information anywhere in the world.
Anywhere.
But when Taibo got in touch with people all over the world, he wouldn't always tell them who he really was. Court documents say he used many fake names like Jack Renfro, Paul Palmer, and Richard Gant, and that he created a number of fake companies to make his deals. For instance, in February 1992, a man who said he was Jack Renfro called Dean Witter's office in New York, claiming to be a Dean Witter trader from their office in Chevy Chase, Maryland. He wanted to do a $5 million trade for a client.
He said go to the desk and tell them right now that he would take it at 556. Can you do that for him?
He wants to buy 5 million long bonds at 1026.
Yes, right now. Get it for him.
Hold on. You are done on 5 million long bonds at 1026.
After doing the deal, when the trader couldn't find any Jack Renfro in the Chevy Chase office, he became suspicious.
Well, how come when I called the Chevy Chase office, they said that there's no one by your name in that office?
Because I just started there. I told you, I don't understand the market very well.
Because why?
I just started there. I'm a newcomer there. So they don't have me in their system yet.
When Dean Witter refused to continue trading with Jack Renfro, a Mr. Richard Gant called using a speakerphone.
This is Mr. Gant.
Yeah, you worked with Jack Renfro?
He works for me.
He works for you?
Yes.
Taibo even succeeded in getting some of the brokerage firms that caught him to pay him any trading profits he made. He wasn't so lucky with Dean Witter.
What's the problem? This is Bob Ferrari. I'm the head of the department.
Yes, there's no problem. My staff bought a security and he told you owe me money.
I owe you nothing. I owe you nothing, and I've got you on tape. You misrepresented yourself, pal. And if you don't want a major case, you better get out of here right now.
What are you talking about, sir?
I have spoken with the branch manager. He does not know Jack Renfrey. You're not authorized to execute a trade against me. You're out.
They allege that you called, used a number of different voices, a number of different accents.
Right.
True, not true?
No, I don't. I have only one single accent. I don't know how to. I don't change my accent. When I call and I want to do a trade, I would identify who I am.
So all of these, what they call them pseudonyms and aliases, which they say were used by you.
Right.
Now, Richard Gant?
Richard Gant is also a partner in RK Gant and Associates.
See, what I would like to see, Mr. Taibo show up in court, Mr. Gant show up in court, shake hands. Surely Gant's going to stand by Taibo. But I think the only way that's going to happen is if Taibo goes in a men's room, puts on a different suit and tie, and comes out.
RK Gant and Associates.
We had the Dean Witter tape of Gant and Renfro analyzed and compared to our interview with Taibo. The conclusion? All the voices are almost definitely the same man. After they were analyzed, Taibo admitted that he had passed himself off as both Richard Gant and Jack Renfro. His explanation? Richard Gant had told him to. But if Gant is Taibo and Taibo is Renfro, they weren't the only names used by Taibo. Paul Palmer.
Paul Palmer is a partner of mine that we joined together to form the JFM Government Securities.
That's Sir Paul Palmer.
Well, Paul Palmer, he used to go by the name Sir Paul Palmer, but his real name is Paul Palmer.
But he's been knighted, that's why they call him Sir?
No, he just used the name Sir.
It's honorific?
No, it doesn't have anything to it.
He just uses it?
He just uses it.
Where does he live?
He's in Africa.
We asked Taibo about one of the companies the SEC says he created called Stein & Stein.
Who is Stein?
There's nobody. You mean Stein?
You said
it's just a name,
company Stein & Stein.
Yeah, there's a gentleman that I met whose name is Samuel Stein that says that we could, join together and form a firm, a partnership. But I was going to be the managing partner who's going to be running.
So Mr. Stein is your partner?
Yes.
What's his first name?
Samuel Stein.
Samuel Stein.
Right.
He's here in Washington?
No, he's not here in Washington.
Where is he located?
Well, they are all back, all of them are back in Africa right now.
So Mr. Stein's in Africa?
Right.
So Stein & Stein, is there another Stein or just the one Stein?
Just one, just a name.
Although we have repeatedly asked, Taibo has been unable to put us, or for that matter, the Nigerian Securities and Exchange Commission, in touch with Sir Paul Palmer, either of the two Steins, or any of his alleged business associates or partners either here or in Africa. When the Nigerian SEC was asked about a few of the companies, they were blunt. The companies don't exist, and the names are fake.
I'm not a crook. I'm just a very knowledgeable investor, someone that you can call a sophisticated investor that wants to be part of the people investing in the market.
And an honest businessman.
And an honest businessman, no doubt.
Well, not exactly no doubt. 4 days later, Daniel Taibo was charged with 17 counts of securities fraud. Right now, he's in jail awaiting his day in court, no doubt.
At 16 years of age, Jonathan Lebed isn't old enough to drink, drive, or vote. Yet federal authorities say he's plenty smart enough to have engineered a sophisticated stock manipulation scheme that's netted him hundreds of thousands of dollars in illegal profits. As we first reported last October, Lebed made headlines around the world for being the youngest person and the first minor ever accused of securities fraud. Officials say his strategy was to buy a stock, hype it relentlessly on the internet, and then sell it when the price soared.
You don't look like a stock swindler.
That's good.
Are you?
No.
Until last fall, Jonathan Lebed seemed to be a fairly typical high school junior in Cedar Grove, New Jersey. He's an avid fan of the New York Mets and professional wrestling. And if anything set him apart, it was his fascination with the stock market.
So this is your office?
Yes.
Command Central?
Of course.
With his parents' permission, he's been playing the stock market from his bedroom computer since he was 13 years old. And as the pile of crumpled 20s on his dresser might indicate, doing quite well. If he'd told his buddies he had made close to $1 million, they probably wouldn't have believed him.
Well, some teenagers my age would be trading baseball cards. I see bigger potential in this.
What was your first investment?
America Online.
Would you buy it at?
$25.
And what did you sell it at?
$30. Not bad.
For someone who has just turned 16, Jonathan Lebed has a relatively long track record for picking stocks. 3 years ago, he and a couple of classmates took 4th place in a nationwide contest sponsored by CNBC.
Jonathan Lebed, way to go, guys.
On paper, his team turned a hypothetical $10,000 into $240,000, enough to convince his parents, Connie and Greg Lebed, he's a supervisor with Amtrak, she's an office temp, that it was time for their son to stop playing on paper and start playing for real.
How much money did he start with?
He started with a few $1,000s. He had bonds, and we had cashed them in.
Hoping that he might turn it into $240,000.
We said it could happen. You know?
It's been done before. Yeah. And you encouraged him to continue to pursue this?
Yes. I thought it was a very good thing for him to be doing.
Did you ever ask him what his secret was?
No, I didn't want to bring no bad luck. I didn't want to know.
Shortly after opening his first online trading account, Jonathan discovered the volatile penny stock market, where shares of small companies ranged from a few cents to a few dollars.
It was a lot more interesting than the larger companies, and it's a lot more fun.
Fun because?
You're searching for the next hot company, the next Microsoft.
You consider it risky?
Risky is the way to go.
Really? Why?
You're not going to get anywhere without taking risks.
What's the largest amount of money you ever put down on a stock?
About $200,000.
Do you have any idea how much $200,000 is?
Well, I still use a 99-cent coupon at Burger King, so.
To minimize his risk, Lebed says he did his own research on stocks by scouring SEC filings, looking through press releases, and by inspecting the companies firsthand, like the time he made his mother drive him to Teaneck to check out a bagel chain.
So I'm there, Jonathan, I don't even know how to get to Teaneck. I'll give you the directions. I said, all right, I'll take you to the bagel store. So we drive all the way to Teaneck. He was all excited. He looked at the whole store. We bought bagels. We went to the park, ate the bagels, and he bought stock in the company.
Based on that trip?
Yes.
Right.
Yes.
You know, he wanted to see the companies he studied, that they really existed and that, yeah, how well they're doing.
Jonathan says he did well in bagels, buying in at 3 cents a share and cashing out at 3.5 cents, all the while honing what he thought was a brilliant investment strategy.
Basically, find companies that are extremely undervalued that would be worth a lot more if everybody knew about it.
So you bought the stock and then proceeded to try and tell people about it?
Yes.
How did you do that?
By sending out messages on chat rooms on the internet.
Hundreds of messages, actually, under a variety of names. His online recommendations, accompanied by legitimate financial data, were always quite bullish. He called one of his holdings the most undervalued stock in history. Another was going to be the next stock to gain 2,000%.
You were trying to make the price of the stock go up?
Yes.
The stock you owned?
Yes.
And then you sold?
Yes.
Like his investment in a small company called Firetector. After buying a large block of shares at $2.45 apiece, he went into cyberspace and plastered messages like this one, predicting that the stock would be at $20 very soon. And just as soon as other investors jumped in, Lebed cashed out, in this case at $3.38 a share, pocketing a profit of $19,000.
And you didn't see anything wrong with that?
No.
Never occurred to you?
No.
Unfortunately for Jonathan, federal investigators didn't see it that way. As it turns out, the Securities and Exchange Commission had been monitoring his trade since 1998, and earlier this year finally decided to accuse him of securities fraud.
This was a calculated, ongoing effort to defraud innocent investors.
Arthur Levitt is the chairman of the Securities and Exchange Commission. He says Jonathan Lebed seems to have mastered an age-old Wall Street swindle called the pump and dump.
What exactly is a pump and dump?
A pump and dump is really buy, lie, and sell high.
You think he knew he was breaking the law?
There's no question about it. He used fictitious names. He made predictions that were without any foundation.
The SEC says Lebed's clear intent was to drive the price of his stock up with hype not even he believed, and then to sell out as quickly as possible.
Master Lebed had no intention of keeping his position. He knew when he made that statement that the stock was likely to go up and he would immediately sell. The purpose of his making that recommendation was not to help investors who were looking at an internet bulletin board, but rather to line his own pockets.
You know the federal government thinks that you were manipulating stocks.
Mm-hmm.
Were you?
Yes.
You were? You admit to that?
Yes, but I wasn't doing anything wrong.
You weren't doing anything. You were manipulating stocks, but you weren't doing anything wrong?
Yeah.
Can you explain that to me?
I wasn't posting any kind of false information. I didn't make up any facts or do anything like that.
Lebed disagrees that the messages he sent out were nothing more than bogus chat room hype. He says his recommendations were always based on accurate information and sound financial analysis. His attorney, Kevin Marino, says the only things Jonathan may be guilty of are not fully understanding the finer points of security law and perhaps a little overenthusiasm.
There certainly are ways one could look at this and say, gee, some of this is misleading, to the extent he says this is the greatest stock in the history of the world, in much the same way as you might be misled if you thought that the car that you bought was really the ultimate driving machine, or if you went to the circus and thought it was really going to be the greatest show on earth.
Did your client manipulate the price of these stocks?
There was some manipulation involved in the price of the stock, but I don't think he committed a crime, and I don't think, as you look at his conduct, that you could draw a principled distinction between what he did and what is done every single day of the week on Wall Street. That is, he touted various stocks, and he sold them after the prices went up.
The distinction, according to the SEC, is that the Wall Street analysts Jonathan Lebed watches on TV are not supposed to profit personally from their own predictions. But even the highly regarded financial publication Barron's seemed to believe that Master Lebed adopted standard brokerage house procedure and put out wildly bullish buy recommendations larded with fancy. What Little John seemingly wasn't aware of was that only chartered financial analysts are legally entitled to engage in the practice.
To take this lad and to try to make him the arch criminal while ignoring conduct of this very stripe that goes on day in and day out on Wall Street is intellectually dishonest, it's cruel, and it's improper.
Marino says most of his clients' postings included a disclaimer: be sure to take the time to do your research. And Yahoo Finance, the internet site where most of his messages were posted, says it's not a good idea to trade or make any investment decisions based on information obtained in a chat room.
Some people have made the argument, look, if anybody who goes in and invests money based on what they read off a bulletin board or in a chat room deserves to lose the money.
Yeah.
That it's like buying a lottery ticket.
I don't share that feeling. I think investors must be skeptical about what they see in chat rooms. But in this instance, 200 to 300 postings on individual securities were made, and that represents, in my view, a wholesale effort at deceiving many investors.
We talked to the chairman of the Securities and Exchange Commission the other day. He's paying a lot of attention to you. He seems convinced that you knew exactly what you were doing and that you ignored the law and cheated innocent investors.
Well, I am not aware of one investor that exists that I cheated, and I don't think that the SEC is aware of one investor that exists that I cheated.
The SEC acknowledged that it didn't receive any complaints from investors who felt they'd been cheated by Jonathan Lebed until after the case became public. Since then, the SEC says it's received about 24 complaints. Rather than go to court over the allegation that he's a crook, Jonathan Lebed negotiated a settlement with the SEC. He agreed to turn over $285,000 that he earned from 11 trades, without acknowledging that he did anything wrong. His lawyer called it a business decision, and given that Lebed made in the neighborhood of $800,000, it seems like a pretty good decision.
What we looked for were those cases of clear violations. In those instances where we could not or did not establish that, we gave him the benefit of the doubt.
And the benefit of $500,000?
Yes.
So he gets to keep that money?
Yes.
So he did all right?
He made a great deal of money. Did he do all right? I don't think so. If he were my son or grandson, I wouldn't think he did all right.
What are your feelings about your son now?
Oh, I'm more proud of him now than ever.
Why?
Because he's a smart boy, and he's done a good job.
You're giving back $280,000.
Does not make me happy.
You'd like to keep it?
He earned it. He did a lot of work. He didn't sit behind a garage smoking pot or stealing wheels off of a car.
What with legal fees, taxes, and his SEC settlement, Jonathan Lebed isn't quite as flush with cash as he was before, but he still has a nice nest egg. And his family is enjoying some dividends from his foray into the stock market.
Jonathan has bought us a car.
A Mercedes SUV, to be precise, price tag $42,000.
You going to be driving it to school anytime soon?
Well, I just got my permit the other day, so...
You just got your learner's permit?
Yes.
Did you pass the first time?
I ran over a cone, but I'm doing pretty well.
While he negotiated his settlement with the SEC, Lebed took a break from investing. He says he has every intention of returning to the market, though he's promised the SEC he won't hype stocks on the internet.
I'm starting to take a look at some companies that interest me right now.
So you're getting ready?
Yes.
You're not going to let this little thing with the SEC stand in your way?
Absolutely not. Why would I do that?
A footnote. Arthur Levitt stepped down as chairman of the SEC in February. As for Master Lebed, after biding his time for several months, he returned to the stock market in early June, investing a few $1,000s in a small video game manufacturer. Lebed told us he'd been doing so well on paper with theoretical investments that he just had to start trading again for real. It's been 2.5 months since Bernard L. Madoff was picked up and charged with what's believed to be the largest financial fraud in history. Yet we still don't know much more about the alleged $50 billion scam than what Madoff initially told the FBI agents who arrested him. There are still no indictments as federal prosecutors continue to unravel the case and to try and figure out exactly what happened and who all was involved. But the proof that it happened can be found in the ruined lives of thousands of victims. The one person who knows the most and is willing to talk is Harry Markopolos, the man who figured out Madoff's scheme before anyone else. He sat down with us for his only television interview. Until a few months ago, Harry Markopolos was an obscure financial analyst and mildly eccentric fraud investigator from Boston, who most people would never notice on the street.
My modern Greek hero, how you doing?
But today he enjoys an almost heroic status, pursued by journalists and movie producers and honored by colleagues as the man who went to the Securities and Exchange Commission and blew the whistle on Bernie Madoff and his $50 billion fraud.
Thank you. Thank you. Please take your seats.
But he seems uncomfortable with all the attention and knows that he is no hero.
I stand before you, a $50 billion failure.
How many times did you send material to the SEC?
May 2000, October 2001, October, November, and December 2005, then again June 2007, and finally April 2008. So 5 separate SEC submissions.
And in spite of all of the things that you did, it still ended up in disaster.
There's nothing to be proud about in this case. I feel horrible about the result. It's been a total disaster for the victims.
It began a decade ago when Markopolos was working for a Boston investment firm. His boss told him that Bernard Madoff, a former chairman of the NASDAQ stock exchange, was running a huge unregistered hedge fund that was producing incredible returns. He wanted Harry to reverse engineer its trading strategy and revenue streams so that the firm could duplicate Madoff's results.
He had the patina of being a respected citizen, one of the most successful businessmen in New York, and certainly one of the most powerful men on Wall Street. You would never suspect him of fraud unless you knew the math.
I mean, you're like a math guy, right?
I've taken all the calculus courses from integral calculus to differential calculus, as well as linear algebra, and statistics, both normal and non-normal.
How long did it take you to figure out that there was something wrong?
It took me 5 minutes to know that it was a fraud. It took me another almost 4 hours of mathematical modeling to prove that it was a fraud.
What were the things that caught your attention?
It was the performance line. As we know, that markets go up and down, and his only went up. He had very few down months. Only 4% of the months were down months, and that would be equivalent to a baseball player in the major leagues batting .960 for a year. Clearly impossible. You would suspect cheating immediately.
Maybe he was just good.
No one's that good.
Harry said there were only 2 plausible explanations. Either Madoff was using insider information to rack up huge profits, or he was running a giant Ponzi scheme. So either way, he was doing something illegal.
Either way, I knew he was going to go to prison.
In May of 2000, Markopolos took his suspicions about Bernie Madoff to the Boston office of the Securities and Exchange Commission. Did you have any financial motive?
Yes. He was a competitor of mine in 2000 to 2004 while I was still in the industry. And when someone's competing on your playing field, who's a dirty player, you want him tossed off the field.
He also thought he might be eligible for a sizable reward if the fraud involved insider trading, but that turned out not to be the case.
In your first letter to the SEC back in 2000, you're a little tentative. You say, look, I have no smoking gun.
In 2000, it was more theoretical. In 2001, it was a little bit more real. By 2005, I had 29 red flags that you just couldn't miss on. By 2005, the degree of certainty was approaching 100%.
Over time, and with some simple math calculations, Markopoulos concluded that for Madoff to execute the trading strategy he said he was using, he would have had to buy more options on the Chicago Options Exchange than actually existed. Yet he says no one he spoke to there remembered making a single trade with Bernie Madoff's fund.
I would talk to the people I had trading relationships with and ask, did you have a trading relationship with Mr. Bernard Madoff? And they all said, no, we don't think he's for real.
Could you find anybody?
I found no one that ever traded with Mr. Madoff, and I traded with the largest equity derivatives firms in the world.
And that's because Madoff's investment fund never actually made any trades, at least going back to 1993 and probably further. A fact confirmed last week at a meeting of Madoff investors by the trustee charged with liquidating his assets. No one knew the depth of the fraud, but a lot of people had questions.
Who else figured this out besides you?
I would say that hundreds of people suspected something was amiss with the Madoff operation. If you look at who the victims were not, you'll notice that the major firms on Wall Street had no money with Mr. Madoff.
I mean, you write this is the letter, I'm quoting from the letter to the Securities and Exchange Commission, red flag number 20. Madoff is suspected of being a fraud by some of the world's largest, most sophisticated financial services firms. And then you list some of the firms.
Yes, I do.
The biggest firms on Wall Street, and conversations with people high up in those firms.
That is correct. And the SEC ignored that.
Did they call any of these people?
All the SEC had to do was pick up the phone. They never did.
If you had executives at the biggest investment houses in Wall Street that knew something was wrong, why do you think they didn't go to the SEC?
Because people in glass houses don't throw stones, and self-regulation on Wall Street doesn't work.
In January 2006, the New York office of the Securities and Exchange Commission finally opened a case file to look into Harry's allegations about Bernie Madoff. Despite uncovering evidence that Madoff had misled them about his investment activities, the SEC closed the case 11 months later without ever opening a formal investigation. The staff said there was no evidence of fraud.
What I found out from my dealings with the SEC over 8.5 years is that their people are totally untrained in finance, they're unschooled, most of them are just merely lawyers without any financial industry experience.
Well, if the people there aren't trained in securities work, what are they trained in?
How to look at pieces of paper that the securities laws require. They can check every piece of paper perfectly and find misdemeanors, and they'll miss all the financial felonies that are occurring because they never look there. Even when pointed to fraud, they're incapable of finding fraud.
No one at the SEC would talk to us on the record about Harry Markopoulos' allegations, but one person who seemed to have had a high opinion of the agency was Bernie Madoff.
I'm very close with the regulators, so I'm not trying to say that they can't, that what they do is bad. As a matter of fact, my niece just married one.
Besides his niece's husband, who no longer works at the SEC, Madoff has had long-standing ties to the agency and has been called upon to give advice. At this 2007 meeting of a nonprofit group called the Philoctetes Center, Madoff seemed to think the SEC was doing a great job.
In today's regulatory environment, it's virtually impossible to violate rules. And this is something that the public really doesn't understand. But it's impossible for you to for a violation to go undetected. Certainly not for a considerable period of time.
But don't try and tell that to the Philoctetes Center today. Its main benefactor, the Betty and Norman Levy Foundation, was fully invested in Madoff, one of dozens of charitable organizations that have been devastated or wiped out. Madoff's customer list, single-spaced with small type, is 162 pages long, with victims running the gamut from Hollywood royalty to a carpenter's pension fund in Syracuse, New York. Shelley Ludlow has been forced to put her mother in a Medicaid-assisted living facility while she packed up their apartment to move in with a friend, all because of Bernie Madoff.
Our whole lives were turned upside down by this man that sits in his penthouse and smirks.
The same day last week, 70 miles away, Len and Marge Forrest were leaving their house that they had just sold in Setauket, Long Island, and were preparing to drive to South Florida to sell their home there. They had their money with Bernie Madoff for 30 years and lost an 8-figure family fortune 2 days before his 80th birthday.
Do you have any money to live on?
Enough, I would say, for 60 days.
Do you know other people who are in the same situation?
Oh, yes. We have a lot. Unfortunately, and I think probably the thing that tears me up more than anything is the fact that I recommended Madoff to a number of people. And they lost their money, and I'll never stop feeling responsible for that. They were all close family and friends.
Len Forrest and his friends thought they were part of a small, exclusive group of investors lucky enough to have a connection with Bernie Madoff. And because they thought they were making 12% a year, they weren't inclined to ask a lot of questions. Harry Markopoulos called it the classic affinity scam.
An affinity scam is when you prey on groups that are similar in nature to yourself. So I'm Greek. If I was going to run an affinity scam, I would run it on the Greek-American community here. Bernie was Jewish, so he ran it on the Jewish community in the United States, but that wouldn't get him enough customers because he always needed new money to keep the scheme going.
Over time, Madoff extended his reach from New York to Palm Beach, where he enlisted hundreds of wealthy clients, many of them recruited from his own country clubs. And he also made connections that gave him entree to Europe and the hedge fund capital of America, Greenwich, Connecticut.
It was here that Bernie Madoff made some of his biggest deals with large investment firms that were willing to feed him billions of dollars of their clients' money to manage. And in return, Bernie Madoff agreed to pay these so-called feeder funds a fortune in annual fees. The largest of the feeder funds was the Fairfield Greenwich Group.
How much money did Fairfield make off Bernie Madoff every year?
Hundreds of millions of dollars.
If you're a feeder fund, what are you supposed to do for those hundreds of millions of dollars?
You're supposed to identify the world's best hedge fund managers and invest only in them, and you're supposed to make sure they're not running Ponzi schemes.
The real steroids here were the feeder funds. That's what made it an international Ponzi scheme.
Attorney David Boies is one of the most prominent lawyers in the country and is representing Fairfield Greenwich investors who lost nearly $7 billion when Madoff went under. They're suing the firm for gross negligence, claiming it failed to investigate Madoff thoroughly or monitor his activities as it promised to do in its marketing materials.
Analysis of portfolio composition, portfolio stress testing, risk management, asset verification. Do you think that really happened?
No, we know it didn't happen because we know all they did was turn the money over to Bernie Madoff, and they did that for 20 years.
They did nothing.
They essentially did nothing except lose their investors' money and enjoy very luxurious lifestyles from the money they took out.
Walter Knoll, one of the founding partners of Fairfield Greenwich, declined to talk to us and has reportedly been lying low with his wife at their compound on the private island of Mystique. But in a statement to 60 Minutes, his firm said that it too was a victim of Bernie Madoff, that it had placed too much trust in his then impeccable reputation and in the fact that there had been multiple reviews of Madoff by the SEC.
Mr. Madoff, what do you have to say for yourself?
In the end, Harry Markopoulos had been right about Bernie Madoff. He will be going to prison, but not because of anything that Harry or the SEC did. In a bad economy, Madoff's lies simply collapsed under their own weight.
No one was investigating Mr. Madoff at the end.
So he turned himself in before anybody in a position of authority began a serious investigation.
That's typically how the SEC does it. They come in after the crime has been committed. They toe tag the victims, count the bodies, and try to figure out who the crooks were after the fact, which does none of us any good.